Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ellie, and today we'll be answering investors' most common questions on gold given its stellar outperformance over the last 12 months. And to do that, we're joined by State Street Global Advisors, Robin Choi. Thank you so much for joining me today, Robin. It's awesome to feature you on the show.
Thank you. Thanks for having me.
What are the main questions investors are asking you every day when it comes to gold?
It's a good question. Some of the questions probably divert to the price level in terms of the outlook, what we expect, where gold price is heading. I think it's quite common for an investor in gold to see if gold price is going to go up or down. So that's the number one question we always get. The second question will be how much gold to allocate. Because from our research, we recommend about 2 to 5% allocation to gold in a portfolio. But it's very common for investors ranging from retail and also institutional. They don't know how much to invest. So a lot of time we have to share a lot of analysis, a lot of back testing to ensure they're comfortable allocating a small allocation in gold. And then the third question will be, what are the ways to invest? What's the best way to invest? The cheapest way? Is it physical, ETFs, futures? So a lot of our time we have to go through the implications and also the considerations using different gold-backed vehicles. So these three questions will be the most common I always get from investors in Asia.
And what are your answers to those questions?
Depending on the investors' considerations and time frame, I think each option has the merits and considerations. Obviously, gold-backed ETFs is very transparent. It's the cheapest way probably to invest, but there's a lot of research investors need to do as well. Investors might prefer physical, and they like to hold it, they like to see it, but the consideration will be where to hold or store the gold. For example, you have a gold that's worth 20 million, for example, Australian dollars, where are you going to put the gold? Is it at your home, at a store, at a vault? So that's some of the consideration investors need to think about.
And then in terms of how much they should allocate, is it different per investor?
It is. We have clients that range from 1% to 30%. But from our perspective, based on our research, strategic allocation 2 to 5 is probably sufficient. Over 5% is probably for those very tactical investors. They believe gold price will maybe spike, let's say 10% in the next 3 months.
And in terms of price, where do you see gold trading over the next 12 months?
In terms of the price range in US dollars, we probably expect 2002 and 2,500 in the next 6 months. That's because we do believe there's very strong drivers supporting gold price at this current moment, including strong central bank buying, strong investors demand, and also we probably expect some kind of risk heading into the US elections that will increase the market volatility in the next 6 months. We actually have a bull case as well. We expect gold price can trade somewhere between 2005 and 2,700. And for that to achieve our target, we need some sort of rise in geopolitical risk and also a rise in tensions around the world that will spur a lot of safe haven buying into gold.
What's the biggest mistake you see investors making when it comes to investing in gold?
The biggest mistake, I wouldn't call it a mistake, but some of the consideration they may have is that they look at gold as one asset class. So they chase the returns, and if gold doesn't achieve the targeted returns, they sell the gold. But gold should be viewed as a component in a portfolio, how it reacts with other asset classes, because ultimately, why institutional investors, why central banks, they buy gold is because it can provide a potential hedge or diversifications because of its historical low correlations to stocks and bonds. So I think the biggest mistake is to not look at gold as a single asset class, but how it react or interact with other asset class that you may have.
Are there any risks that investors should be aware of when investing in gold? I feel like all investments are risky in some way or another. Is the same true for gold?
Yes, indeed. Gold obviously has no cash flows, does not pay a dividend and interest. So extremely difficult to forecast the expected returns. So without the cash flow, investors have to evaluate gold by looking at other factors like macro factors, the currency market, and also supply and demand. So the risk will come from not doing the proper research to see how gold will interplay with other financial markets. Another risk will be too focused, as I said before, on one asset class alone. Gold needs to be seen as an asset class that can interact with other asset classes as well, how it can provide that diversifications.
Okay, well, thank you so much for your time today, Robin. It was awesome to feature you on the pitch.
Thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.